Today, Bitcoin just plunged to inflation-era lows, erased nearly half its all-time gains, triggered billions in liquidations, and pushed fear to levels we haven't seen in years. If you want to understand why BTC broke 64K, what the on-chain panic signals mean, and where Bitcoin might head next, you must watch this full breakdown. Hey everyone, welcome back. I'm Preyo Promo, and I've been trading and analyzing Bitcoin for 10+ years across multiple cycles. Today, we're unpacking one of the most extreme Bitcoin sell-offs in recent history. With real data on liquidations, RSI extremes, historical positioning, and macro signals that every trader and investor needs to understand before making their next move. We'll cover why this crash happened, what the technicals are telling us, where smart money is hiding, and whether this is a bottoming process, or just the start of a deeper reset. 1. The breakdown that shocked the entire crypto market, 1:30–3:30. Bitcoin just experienced one of the most aggressive breakdowns in modern crypto history. After holding above the $70,000 psychological zone for months, price violently sliced through key supports and plunged toward the $64,000 region, a level many investors never expected to see again this cycle. What makes this crash different is context. From the late 2025 all-time high near $126,000, Bitcoin has now corrected almost 50%. That's not a normal pullback. That's a full structural reset. Entire rally gains have been erased. Market structure flipped from bullish continuation to distribution and forced liquidation. This wasn't driven by news headlines alone. This was leverage unwinding across the entire system. This move didn't ask for permission. It forced the market to deleverage. And when Bitcoin deleverages, it doesn't do it slowly. 2. Liquidation hell. When leverage turns against everyone. 336 SAO. Within hours, the market saw $775 million to over $1 billion in leveraged positions wiped out. Longs didn't get a chance to exit. Stops were skipped. Liquidation engines took control. This is what happens when excessive leverage builds up for too long. Volatility becomes the weapon. As positions were force closed, selling pressure intensified, which triggered even more stop losses, which then caused cascade liquidations. It becomes a self-feeding cycle. Leverage unwinds, price drops, liquidations trigger, volatility spikes, more positions get wiped. This environment doesn't just hurt retail traders. It pushes funds, desks, and even market makers to reduce exposure completely. Liquidity disappears fast, and price falls even faster. 3. Smart money steps. Back institutional exit and short pressure, 6,830. One of the most critical shifts during this crash was institutional behavior. Spot Bitcoin ETFs, which previously acted as strong demand engines, began seeing multi-billion-dollar outflows. When institutions leave, they don't panic sell like retail. They step back. That distinction matters. As institutions reduce exposure, bid depth shrinks, spreads widen, and price discovery becomes thin. This creates a vacuum where even small sell orders can push price aggressively lower. At the same time, short positioning increased. Not because traders were confident, but because momentum demanded it. This is how markets slide when nobody wants to catch the falling knife. 4. Weekly RSI at levels only seen during major market stress, 8:30–11 SAC. Now let's talk technicals, because this is where things get interesting. Bitcoin's weekly RSI plunged into rare oversold territory, levels historically associated with macro bottoms, relief rallies, long-term accumulation zones. But here's the key point most people miss. Oversold does not mean reversal. It means fear is extreme. It means sellers are exhausted, but buyers still need confirmation. These are the zones where long-term investors start paying attention. Not for instant pumps, but for risk-to-reward asymmetry. Markets don't bottom when everyone feels confident. They bottom when fear feels permanent. 5. Capitulation volume, the signature of weak hands exiting, 11–1330. True capitulation is not about price alone. It's about volume behavior. During this sell-off, we saw heavy volume spikes on red candles, signaling mass exits. This is what weak hands look like leaving the market. A panic selling. Market orders at the lows. Emotional decision-making. Historically, these volume spikes often appear near major turning points, but only after confirmation. Capitulation clears the market of emotional participants, making room for stronger hands. But remember, capitulation is a process, not a single candle. Quick note, if this analysis is giving you real clarity, hit like and subscribe. This channel is about understanding Bitcoin cycles, not chasing noise. All right, let's continue. 6. Retail pain phase. Why maximum fear comes before recovery. 13:30:16 hours. Right now, most retail participants are underwater. Average entry prices sit far above current levels, and sentiment has shifted from optimism to despair. This phase feels brutal, because it is. But historically, major corrections force out short-term speculators and leave behind investors with longer time horizons. This is where narratives die. This is where hype collapses. This is where markets quietly rebuild. Strong trends are born from painful resets, not viral tweets. 7. Macro pressure cooker. Bitcoin versus global risk sentiment. 16/1830. Bitcoin isn't trading in isolation. Global macro pressure is intense. Tight monetary conditions. Strong dollar environments. Risk-off sentiment across equities. In this environment, capital doesn't chase upside. It protects downside. Hedge funds may still view Bitcoin as a strategic asset, but they size positions defensively during uncertainty. Macro cycles dictate crypto more than most people want to admit. Ignore macro, and you trade blind. 8. Cross-market signals. Bitcoin's correlation shift explained. 18:30:21 LAS. During this crash, Bitcoin's correlation with equities tightened sharply. Instead of acting like digital gold, Bitcoin traded like a high-beta risk asset. This matters. When correlations compress, capital rotates faster and exits faster. Watching assets like silver, gold, and stocks helps identify whether Bitcoin is being treated as risk protection or risk exposure. Right now, the market is still undecided. 9. This is a base-building phase, not a moonshot setup. 24 hour. Let's be very clear. Bottoming does not mean mooning. Bottoming looks boring, sideways, frustrating. Volatility compresses. Fake moves shake traders out. Confidence rebuilds slowly. Only after key resistance levels are reclaimed does a true trend reversal begin. This market is building a base, not launching a rocket. 10. Final reality check. What smart investors actually do here. 24/26. Markets become healthier when leverage is flushed. This reset, as painful as it feels, removes excess and restores balance. But timing is everything. Chasing bottoms destroys capital. Waiting for confirmation preserves it. The goal isn't to predict the exact low. The goal is to survive long enough to profit from the next cycle. Bitcoin rewards patience, not emotion. If you found this breakdown valuable, smash that like button and subscribe Preyo promo for deep crypto market analysis that actually helps you navigate volatility. Drop a comment. Where do you think Bitcoin's next key support lies? And if you want a follow-up price action deep dive, let me know.